Hello, ladies and gentlemen. My name is Joe Hacker, and I will help you to become a quant. You're done with your business plan. You want to create your cash flow statement. However, it just doesn't work. The change of the cash positions is not equal to your net cash flow. What can we do? Well, here are 10 steps of how this problem can be solved. Let's get started. Step number 1, check the completeness of the business plan. Use the book Financial Modeling from Joachim Hecker and Dietmar Ernst. We're using page 544 to 546. We make sure that we connect our expenses to the total sales. We calculated the EBIT. Then we calculated all the non-current and current assets positions, move forward to the liability side. After that, we came to the equity position. And then last but not least, we're going back to our EBIT and finish our P&L position. And we come up with a net income. We subtract the dividends and all the entire rest, the so-called retained earnings, is being put into the equity position. And we have done that in our pharma group case. So basically, we just copy-pasted the last 3 years, the figures of the last 3 years, or the P&L, assets, equity, and liability side. We planned the income statement. We derived the assumption of the assets and equity and liabilities. And finally, we also came up with the assumption for the depreciation amortizations. Based on that, we came up with the next 5 years of the P&L, including the planned terminal value, and also calculated the dividend, and we derived the asset side, we derived the equity and liability side, in order to make sure that total equity and liability equals total asset. We come up with two positions, the so-called excess liquidity and the so-called financing gap. So we're using the excess liquidity as an overflow valve to make sure both the balance sheet is balancing. So that we are done. And now we want to create our cash flow statement. How can we do so? Well, we start with step number 2. Step number 2, select the positions in the profit and loss account that need to be implemented into the cash flow statement. Well, we started with total sales. We subtracted the cost of goods sold. We subtracted the selling expenses as R&D. We subtracted the G&A. And then any income position needs to be added. Any expenses position needs to be subtracted. So this leads us to the earnings before interest and taxes. This is our basis for our calculation. Between earnings before interest and taxes and earnings before taxes are mainly 3 positions: the results from associates. You accounted for using the equity method. The financial income and the financial expenses. The income will be added, the expenses will be subtracted. That leads to our earnings before taxes. Then we pay taxes. Taxes means money is out. Taxes is money out. And then we come up with earnings after taxes. Then we pay the so-called non-controlling interest, leading to the net income. Then we pay dividend to our shareholders. And finally, we come up with our retained earnings. How many positions did we use? 7. Step number 3, select the assets positions that need to be implemented in the cash flow statement. Well, asset position, it's quite easy. Non-current assets, all those positions need to be taken. So we use the goodwill, The other intangible assets, property, plant, and equipment, investment accounted for using the equity method, other non-current assets, and finally, deferred taxes. On the current side, we have to be a bit careful. We use the ones that are being used in the net working capital, that among these are inventories, trade account receivables, as well as other assets. However, we do not use the cash and cash equivalent, as well as we do not use the excess liquidity, because as we pointed out earlier, we're using that as an overflow valve to make sure the balance is balancing. So how many positions did we use? We used 9 positions. Now we're coming to the equity and liability side. The equity liability side, we're using the subscribed capital, capital reserves, and the equity attributable to non-controlling interest. And depending how you calculate your dividend, how this is being done, how you connect your net income, i.e. retained earnings, with the equity position. Here, my example, it's done via those 2 positions. You just do not take that into consideration. So we continue with the non-current liabilities, the provisions for pensions, the other provisions, financial liabilities, other liabilities, deferred taxes. And these are the non-current liabilities, not the current, the non-current liabilities. Then we continue with the current liabilities, financing gap, other provisions, financial liabilities, trade accounts payable, income tax, and other liabilities short term. So how many positions did we use? We used 14. Step number 5, link all selected positions to the net cash flow calculations. So what are we doing now? Well, we start with the EBIT, the operating result, which is here. Just link it. And then we come up with the, let's check where the next one is here, the result from associates. We can pull that down, 1, 2, because then we come up with the financial income, the financial expenses. Then we pay taxes. I extend that a bit so you can see it perfectly. It's a bit small. No? So next one after the financial expenses are the income taxes. Here we go. They are subtracted. And then the non-controlling interest. Here we go. And finally, we take care about the dividend. So in terms of numbers, this equals the EBIT of the first year, which is here. Then the results from associate is this one, which you can pull down, 1, 2. You come up with the income taxes, which is here, 1 billion. The non-controlling interest, 21 million. And finally, the dividend. Dividend is a money out, so here's dividend. And my P&L positions sum up to equals operating result, EBIT plus, because here it's indicated as a plus, results from associates accounted for using the equity method, then plus financial income, minus financial expenses, minus taxes, minus non-controlling interest, minus dividend. Because here, cash coming in, here cash coming out. So 1,437,000,000. And we can grab that and move it all the way up there. And we are done with our P&L positions. Now we come to the asset positions. Basically, all the asset positions means money out. Cash is leaving our balance sheet. On the other side, equity and liabilities, we receiving cash. For example, we need money, we go to the bank, we ask for a credit, interest-bearing liabilities position increases. So this is a money in. So now we subtract all the assets positions and we add all the equity and liabilities positions. So what are our assets positions? Assets positions are the goodwill and the other intangible assets, the property, plant, and equipment, the investments counted using the equity methods, the other non-current assets, as well as the deferred taxes. So you see here, how many of them did we use? 1, 2, 3, 4, 5, 6. Did I use all of them? Let's check. 1, 2, 3, 4, 5, 6. Yes, correct. By the way, how many P&L position did we use so far? 7. So this indicates here 1, 2, 3, 4, 5, 6, 7. And we calculated the sum, and the sum 7 equals the ones we selected here. So that is correct. Here, on the asset side, we need to add the current assets. How many do we have here? 3. Therefore, we need the following 3 positions. Change in inventories, it's here. And change in trade accounts receivable and change in other assets. The other ones, cash and cash equivalents, excess liquidity is not taken into consideration. So how many positions do we have here? 1, 1, 1. We add it all up. And this is 9. How many did we select? 9, 9, check. Everything correct. Now, in terms of numbers, in terms of financial figures, this is the goodwill here. And we can basically move it all the way down to all the non-current assets. However, as you see here, the profit and loss account is just the position occurring in that respective year. Now we're talking about change. So change implies assets, H7, minus assets, G7. So this one minus that one. It's the change. So you see here, don't put the absolute number down there. It's always the change. The same occurs in inventories. Inventories equals the first projection minus the current year in terms of inventories. And I move it all the way down. And then I can move that here. And now I just subtract all of them. Equals, and we start with a minus. Minus goodwill, minus this one, minus other non-current assets, minus deferred taxes, minus inventories, minus trade accounts receivable, and finally minus other assets. And that is my asset position. So everything has been subtracted. Now everything needs to be added. What am I taking? I'm taking the change in subscribed capital. I'm taking the change in the capital reserves, and then I'm taking the equity attributable to non-controlling interest in terms of financial figures. This is this one minus that one. So no capital increase occurred. The capital reserves didn't change, and the equity attributable to the non-controlling interest. Here in our case, there's also no change. And we are done with this position. Now we move forward to our non-current liabilities positions. We use the change in the pension provisions. That is here equals pension provisions minus the old year. It's 737. Then we take the change in other provisions, the change in other financial liabilities, the change in financial liabilities, then the change in other liabilities, and then the change in deferred taxes. So I can pull that all the way down here. Now, take it 1, 2, 3, 4, and one more. So this is a change in non-current positions, as pointed out. We end up at the deferred taxes. Just checking. I'll do that here. Equals provisions, and I move it all the way down to deferred taxes. From provisions to deferred taxes, from provisions to deferred taxes. Here, all the changes being calculated. And now I'm coming to the current liabilities. So what are the current liabilities? The change in the financing gap, which is here, this one minus that one. No, and this of course goes there. And my position is the financing gap. I pull that all the way down, and it should end at other liabilities, correct? And my financing gap is the change of the first planned year minus the current year, so I can pull that all the way down. And these are my results. So my equity and liabilities position is just the entire sum. So what I do, I just move all of them towards the terminal value. And then this leads me to my equity and liability positions. How many positions did I use? I used many, actually, and just double check. We add them all up. and it tells us 14 positions. How many did I select? Also 14 positions. So we didn't forget one. How many are there in total? Well, equals 7 plus 9 plus 14. And this is 30. Now I want to calculate my net cash flow. And my net cash flow is calculated as my result of the P&L positions plus my results of my assets positions plus my result of my equity and liability positions. And this leads me to the following net cash flow. And now I want to check whether everything is correct, because I want to know what was my cash position at the end of last year. Well, we go there and go to the asset side. Where is the cash? It's here, 1662, no excess liquidity, of course. So when that moves forward, this is also the cash position on the 1st of January of my new year. What's the cash position of the last year? Or at the end, what is the cash position of the end of my first year? And there we take the cash position plus, don't forget that, the excess liquidity. And that is my position at the end of the first planning year. What's the change? The change is this one minus that one. And the change is 1,242,000,000. And surprise, surprise, we can tick the box. The net cash flow equals the change. So what I can do next, I can move that all the way up there, and we see check, check, net cash flow equals change in cash position. And that's the very important thing. If you realize that, and you know, this position, net cash flow calculation, this is not so difficult. You just make sure you use all the P&L position, you use all assets position, you use all equity and liabilities position. All the P&L positions are added if it's a income, subtracted if it's an expense. All the assets positions are being subtracted because it means money out. All the equity positions means money, equity and liabilities position means money in, therefore they are added. And that's quite easy. And all we did is we made sure that we didn't forget a position, that we just didn't make any mistake concerning a plus or a minus, and it all works out. And we're just comparing the positions. Let's check out P&L position. That was how many? 7. The asset position, that were 9. And the equity and liabilities position, that was 14. How does it look like now in our net cash flow statement? Here it's 7. Here it's 9. And here it's 14. And check, we made it. We made it, everything is matching. So we calculated the net cash flow. So what are the components of a so-called cash flow statement? Based on our pharma group example, you see that the cash flow can be divided into an operating cash flow, an investing cash flow, and the so-called financing cash flow. All three together come up with the net cash flow. And we're going to compare that net cash flow with the net cash flow calculation we made here. And if it's the same, everything worked out. The cash flow statement is basically structured. It starts with, like the free cash flow, like with the EBIT. Then we are adding the depreciation amortization. We're adding the provisions. We are subtracting the change in net working capital. And then we're adding the CapEx. This basically is almost the free cash flow. So this structure is actually maintained. And I defined the following categories we'll carry out now in order to make sure we put the positions of our net cash flow, our P&L position, asset positions, and equity and liabilities positions in the correct position of the cash flow statement. We start here with position number 1, with the profit and loss account position. Then we continue towards the interest-bearing liabilities. What are interest-bearing liabilities? We continue with our provisions, then the change in equity, all have different colors, then the change in deferred taxes and tax liabilities, then the non-current other liabilities, the working capital asset side, the working capital liability side. Then we move towards the depreciation amortization, and finally, last but not least, the CapEx, capital expenditure. So let's get started with part 1, P&L position. P&L position, we had 7 P&L position here. So let's go and look, where do we put the P&L positions? Well, we always start with the EBIT, earnings before interest and taxes, which is here. So we start with the EBIT, and this is our EBIT calculation done. Then we also pay taxes. So we'll take the taxes into consideration, income taxes. In our case, equals taxes, 1,018,000,000. So we are done in terms of operating cash flow. Now we come to the financing cash flow. In the financing cash flow, we are having the dividend that needs to be paid. Here, dividend. The dividend in the first planned year equals 1,718. Then we are paying the non-controlling, we are paying the non-controlling interest. Non-controlling interest, which is this one, 21. And I extend a bit so you can see it better. Now we're taking the result here from associates accounting for using the equity method. And this is one of the 3 parts of the interest result. And therefore I can pull it down. The result from associates is 0. And I can pull that down. So now I have 1, 2, 3, 4, 5, 6, 7 green position, P&L positions. All are done. And how many P&L position did I have? Well, I had 7 P&L position here. how many P&L position do I have here? I just wrote down the word P&L, equity, liability, and asset in order to distinguish between profit and loss account, balance sheet left, balance sheet right side, basically. And how can I link or how can I count that? I can make that with the following formulas: sum if, and then I connect it to a cell, if S, open the brackets, and then I'll take all the values in C to 47, because I just marked here 1 if that is a respective position. And then I connect it to my words P&L, balance sheet, assets or equity and liabilities. And of course, I need to link it to, in this case, to P&L and say, give me all the figures that show a P&L, press return, and here we go. I see this is 7. Just to make sure I can pull it down later on, I just plug in specific dollars. Here the dollars, so I can pull it down in a minute. And C66, I just plug in a dollar here. So here we go. So I checked P&L 7 in the net cash flow calculation. In my cash flow calculation, the formula sum if S gives me the respective positions and it adds them all up, and it says also 7 being used. Okay, tick the box. Now we are moving forward to the equity and liabilities side. Have a look, change in interest-bearing liabilities. What positions are interest-bearing liabilities? Well, financing cash flow gives me an answer, because in the financing cash flow, I know where do I get my money from to invest into the respective asset position. So what are interest-bearing liability positions? I start with the current financing liabilities, which is pointed out here. These are my financial liabilities, and the respective position is this one here. Done. I'm pointing it out with the long-term or non-current financial liabilities position. This is here. And I link it over there. Here we go. Then the pension provisions are also interest-bearing liabilities. They are here. So the pension provisions connected. Here we go. And last but not least, don't forget the financing gap, which, unlike the excess liquidity position, needs to be taken into consideration. Financing gap. And in our case, it's a 0. Financing gap, 0. Done. So I analyzed the change in interest-bearing liabilities position. So I defined what positions are interest-bearing liabilities. Next one, I'll add the provisions, because the formula is EBIT plus provisions. So where are the provisions? I have them here. My provisions, I click on here. Change in non-current other provisions. Non-current other provisions are 0. And I'll take the change in other provisions current, and the current positions are also 0. So anything concerning accruals, provisions is in there and it's being added. Done. Next one, I'm having a look at the change in equity. The change in equity we saw on the equity side is this one, that one, that one. So you see here, no capital increase has been made. So the change in equity is basically 0. It needs to be put in the so-called financing cash flow because I can get either money from the bank in form of a credit or I issue a bond. So this is all debt. And here it's the equity position. So change in subscribed capital of Pharma Group, capital reserves of Pharma Group, and of course equity attributable to non-controlling interest. In the financial figures, the correct financial figures is a 0. And a 0 and a 0, no capital increase has been made in our case. So that one is done as well, change in equity. Next comes the change in deferred taxes and tax liabilities. The whole tax issue is not in the financing, not investing, but in the operating cash flow. So I'll put in the change in deferred taxes on the asset side, which then needs to be subtracted, therefore a minus. So that's a 0. Now comes the change in deferred taxes on the liabilities side here, which needs to be added, therefore a plus. So also 0. And finally, the change in current assets, change in current, and then click on it, current income tax liabilities. So my income tax liabilities, the change is also 0. Done. So I'm done with the asset side, the liability sides of the deferred taxes, and the income tax liabilities. Next step, I'm moving forward to the non-current other liabilities. Where is this? Well, I plug it in here. Non-current other liabilities. Let's have a look. Where is that? Non-current, change in non-current other liabilities. It's this one. And that is a small position, and it's definitely not big. It's a 0. Non-current other liabilities is 0. Okay, done with this. What's the next step? Now I'm moving forward to the working capital asset and liability side. So the working capital is not in the financing, of course, not investing, but in the operating cash flow. I'll point out my change in working capital positions of the asset side. They are subtracted. And then on the liability side, they are added. Okay, let's get started. Where are they? Well, I'm having here inventories. Inventories, trade accounts receivable, other assets. So my inventories are here. And I just can pull it down. So these positions are subtracted, and I'm having all my current liabilities except of the current provisions and the current financial liabilities. All the other positions, and of course, except of the taxes, which are pointed out here, the other positions are included in that part. And I'm having the remaining position trade accounts payable, which is the core position. Trade accounts payable. And I also use the other position, what is left. Let's check out trade account. Income tax we already have. The change in current other liabilities. That is the remaining position. How did that change? 77, press return. So we are done with that. Asset side minus, liability side plus. Then I move forward towards the position depreciation amortization, which is pointed out in blue. Well, I take the EBIT plus the D&A plus the change in provisions. So where do I get the depreciation amortization from? Well, I planned it in my assumption sheet. Amortization of goodwill, amortization of intangible assets, depreciation on property, investments, and non-current assets. So you see here, in my asset side, I'm having 1, 2, 3, 4, 5 assets position, except of the deferred taxes, which I took care in here in the deferred taxes on the asset side. This is this position. So basically, I'm having 5 assets positions. Therefore, I'm having 5 of those non-current assets positions, which are being depreciated slash amortized, where on which I'm having 5 non-current asset positions on which I will apply the depreciation slash the amortization. So it's the depreciation of property, plant, and equipment. It is the amortization of investments accounted for using the equity method. And it is the amortization of other non-current assets. So basically you see depreciation is on tangible assets such as property, plant, and equipment. Amortization is on intangible assets such as goodwill, other intangible assets, and then investments accounted for using the equity method and some other non-current positions. So I'm also pointing out the respected positions, the respected financial figures. And now I'm almost done. Only one thing is missing, one position, which is just basically the counter position of the depreciation and amortization. And this position is the capital expenditure, CapEx. Whatever I invest in form of CapEx will later on be depreciated / amortized. So what is my investment? How can I calculate my investment? Well, I use that investment in, and then have a look, in goodwill, other property, invest all the 5 assets positions I mentioned earlier. So those 5 asset positions are the basis for my capital expenditure. How do I calculate that? Well, now I have to be careful. This is my change in goodwill, which is marked here. But now I need to add the depreciation and amortization of my respective position, which is here amortization of goodwill, this one here, and press return. So basically, I always calculate the CapEx as change in intangible assets plus the respective depreciation and amortization. So I can pull it all the way down. And now let's have a look whether we made any mistake. Let's calculate the operating cash flow equals EBIT. And now always check, is it a plus or is it a minus? Equals EBIT plus D&A plus change in non-current other provisions plus change in current provisions minus the change in inventories because it's on the asset side minus the trade accounts receivable. These are the working capital components minus, and then I plus the liability parts of the net working capital. And then I'm done, and then I add the other change in non-current other liabilities. I subtract the taxes because it's a money out. On the asset side, the position is subtracted, i.e. those deferred taxes are subtracted. On the liability side, it's added, therefore it's the deferred taxes are added. And the change in current income tax liabilities are also added. That's a huge formula. I press return. And now this is my not my free cash flow, but it's actually almost the free cash flow, including the investing cash flow minus the change of the taxes. But this one here is the operating cash flow, which I calculated, and my investing cash flow can easily be calculated by just subtracting everything, minus, 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 minus. So I'm using all those parts moving forward, and this is my investing cash flow. So now how does my financing cash flow look like? And you see here, I'm having minus the dividend. So let's do it here. Equals minus the dividend minus the non-controlling interest plus if there's a change or a capital increase plus the money I got from the banks or by issuing bonds plus the interest part in my P&L. So the financial income is an income. I get it from my cash position, which I bring to the bank. And I subtract the financial expenses, my credit, short-term, long-term credits from the bank. I press return. And this is the result. I'll take all the financial figures, move it all the way up the 5 years business plan plus the terminal value. And this is my my financing cash flow. And now it's very important. Did we make a mistake or is everything okay? We'll take the operating cash flow, we plus the investing cash flow, and we plus the financing cash flow, and we get that result. So now have a look. How does my balance sheet position look like? Well, it was 1,662. At the very end of the last year, let's go to the asset side. What is my balance sheet position? It's 171 plus the excess liquidity. That's it. And the spread is this one minus that one. And I can take all that and move it all the way up there. And my spread is exactly my net cash flow. And this says everything is okay. And I can cut it out just to make sure and check. Go to my net cash flow calculation. Throw it in. It's a bit too big. And compare it to my result I received here. And you see exactly the same position. So my net cash flow calculation has been correct and my cash flow statement has been correct. Now I can finally check one more time how many assets position did I use. Well, check on asset, 9 positions. How many positions did I use? Well, I should be able to pull it down. Yes, here. Sum if S selects the one where you see assets. And how many equity and liability position have I used? Well, equity liability positions, 14. How many are being used here? 14. Total, well, the total 30. Total 30. Everything is okay. So we are done. We made it. What was difficult? Where can I make mistakes? Well, mistake number 1 very often is that you forget positions. That's why I suggest to start with the P&L, assets and equity and liability. Go through all positions and highlight the ones that are not relevant. Second, a minus or plus. Here, it's quite tricky. Is there a minus or plus? Do I make minus dividend or plus dividend? You know, minus, plus, minus, plus. It's quite complex here on the operating cash flow. That's why we implemented a net cash flow calculation. There it's very easy. Everything on the equity and liability positions is plussed. Everything on the asset side is subtracted. And in terms of P&L positions, we start on EBIT level, we add all the income positions, and we subtract all expenses positions. Now you got all the pluses and minuses already there. And as you see, I just linked the positions. And with the linkage, I also get the, look here, the plus and minus. I had link net cash flow calculated in D11. Look, I linked it and the minus comes with it. So I know minus taxes. Taxes are an expense. Expenses implies a money out. So I need to subtract it here. And next step, how can I categorize? How can I structure everything? I came here with the following positions. I derive the following 10 positions, 10 position. Profit and loss account, D&A, provisions, the working capital asset / the liability side. Here, non-current other liabilities, change in deferred taxes and tax liabilities, CapEx, change in equity, change in interest-bearing liabilities. This is basically the skeleton of a P&L and balance sheet. You might have slight changes here, but the structure should be the same. So it helps pointing out different colors, and by coloring it and making subsets, I make sure I get it all in the correct position with the correct minus or the correct plus. And then I can check change in cash, and I make my checks with the sum if s formula. Ladies and gentlemen, I hope you enjoyed the little video. It was actually not a little one, it was a big one, but we heard so much about people really struggling heavily on the creation of a cash flow statement. I mean, the business plan, it's quite a big challenge, but making sure the balance is balancing should be doable with a so-called overflow valve / on the other side with a financing gap. But usually people struggle with the cash flow statement. And although this is now a longer video, I hope this helps you to avoid any mistake and to come up with a correct cash flow statement. See you later, ladies and gentlemen. Bye-bye.